Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. Global bond yields decreased significantly in September 2024, with 10-year US Treasury yield, 10-year Germany bond, and 10-year Japan bond softening by 14 basis points S, 16 bps, and 4 bps, respectively. The 10-year GSEC traded in a band of 6.72% to 6.87% and closed at 6.75%, September 2024, vis-à-vis 6.86% in August 2024. Yields of 91-day T-bill, 182-day T-bill, and 364-day T-bill softened by approximately 26 basis points, approximately 17 basis points, and approximately 17 basis points, respectively, as RBI cancelled last two auctions for the quarter amounting to Rs 40,000 crores. Indian benchmark bond yields were lower broadly by 10 basis points during the month. In tandem with UST yields, which drifted lower, 10-year Indian government bond crossed crucial 6.80% levels mid-month. Fed rate cut of 50 basis points, favorable crude, 69.2 to 77.5 US dollars per barrel range, weakening US dollar index and borrowing calendar for H2 FY 2025 in line with expectations led to 10-year Indian government bond hovering around 6.75%. Rest of the curve drifted lower in sync with the United States Treasury yield movement and continuance of FII inflows. CPI inflation rose to 3.65% in August 2024 from 3.60% in July 2024. The reading also came in marginally higher than the Bloomberg's median poll of 3.47%. Although on a sequential basis the headline index remained unchanged, unfavorable base of approximately 5 basis points led the year-on-year reading to increase from 3.60% in July 2024 to 3.60% in August 2024. Food and beverages inflation marginally increased to 5.30% in August 2024 from 5.06% in July 2024. Vegetables observed higher inflation of 10.66% in August 2024, an increase from 6.83% in July 2024. Pulses and products continued to maintain their double-digit price increase at 13.60% in August 2024, although marginally lower than 14.77% in July 2024. Also, cereals and products inflation saw a slight dip at 7.31% in August 2024 from 8.14% in July 2024. On the other hand, spices noted a higher deflation of -4.40% in August 2024 as compared to -1.43% in July 2024. In August 2024, the CPI ex-food and beverages stood below 4.0% at 2.26% for the 12th consecutive month. Core inflation surged slightly to 3.4% in August 2024 from 3.39% in July 2024. Transport and communication jumped to 2.71% in August 2024 from 2.60% in July 2024, highest in the last 17 months. During September 2024, US dollar traded with a weakening bias and depreciated by approximately 1.21%. The US Federal Reserve started with the much-awaited rate cut cycle with a massive 50 basis points rate cut. While US dollar depreciated during the month, Japanese yen, on the other hand, continued its appreciating trend. Though Japanese yen appreciated during the month, it still remains substantially weak relative to Chinese yuan renminbi, CNY, Indian rupee, INR, and Indian depository receipt, IDR. Indian rupee appreciated by 0.14% in September 2024. Indian rupee traded in the range of rupees 83.56 to 83.98 per USD during the month and ended the month at rupees 83.76 per USD. Foreign portfolio investors, FPIs, were net buyers in both equity and debt markets in September 2024, with inflows of rupees 57,724 crore and rupees 32,850 crore respectively. Forex reserves reached the highest level at $692.3 billion as on September 20th, 2024 from $681.7 billion a month ago. Liquidity conditions during September 2024 noted momentary tightness following the outflows related to advance tax and GST, however balanced thereafter towards the end of the month. Daily average liquidity surplus moderated to rupees 1,916 crore in September 2024 from a daily average surplus of rupees 1,50,897 crore in August 2024. Due to some tightness in liquidity, the daily average of weighted average call rate stood at 6.55%, marginally higher than the previous month's average of 6.52%. Since June 2024, the RBI has outright sold securities worth rupees 24,070 crore in view to absorb excess liquidity, although the quantum of these open market operation OMO sales has been modest. Bank credit growth stood at 13.4% as on September 6, 2024 on a year-on-year basis, marginally lower than a month ago level of 13.6%. Bank deposit growth, on the other hand, improved marginally to 11.2% as on September 6, 2024 from a month ago level of 10.9%. Credit growth continued to outpace deposit growth, which remains a key concern for the RBI. The economic indicators continue to show a mixed picture, especially with strong indicators such as robust GDP and retail spending. However, slowing labor markets and moderating inflation seems to have tilted the odds towards softening of interest rate stance by the Federal Reserve System. The Federal Reserve System has started its rate cut cycle by reducing rates aggressively by minus 50 basis points. The dot plot projects further rate cut of 50 basis points in the remainder of 2024, 100 basis points in 2025, and 50 basis points in 2026. External commercial borrowing, ECB, is also expected to continue to be on a rate cut path in the foreseeable future, though they have refrained from committing to any particular path. Key monitorable remains from developments in China as well as Japan over the medium term. China would be expected to have support both from monetary, but more importantly fiscal side to get its house back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of for import-dependent nations like India. Japan, on the other hand, shall be on a rate hike journey, and the resultant impact of unwinding of yen carry trades on various asset classes would be another important monitorable. Reasons for being cautious in India are, while domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. Despite the flows related to inclusion in the bond indices beginning from June 2024, the Indian rupee seems to continue to be very range-bound. However, if our hypothesis of a weakening dollar remains valid, then fear of further INR depreciation reduces for now. The deposit credit gap in the banking system has sustained for a while, indicating that the shorter end of the curve may see higher supply due to the battle to raise deposits in the financial sector, thereby putting a floor for the overall curve. However, reasons capping the domestic yields and dictating our fund positioning are flows from offshore investors due to inclusion in the global bond indices from June 2024 onwards, which has resulted in a positive demand-supply equation, a reduction in overall fiscal deficit for the year as announced in the budget with commitment to reduce it further over next few years. Fairly positive real rates. CPI for FY25 projected by RBI is 4.5% and repo rate is at 6.5%, maintained for a while.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.